Today, more aggressive tightening, says RBNZ, as rates rise to 2%. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and prop news with a distinctively Australian and New Zealand flavour. Well, New Zealand remains a petri dish for monetary tightening, as the Monetary Policy Committee there today increased the official cash rate to 2%. They said that the committee agreed it remains appropriate to continue to tighten monetary conditions at pace to maintain price stability and support maximum sustainable employment. The committee is resolute in its commitment to ensure consumer price inflation returns to within the 1 to 3% target range. In response, the New Zealand dollar gained more than half a US cent to a 3-week peak, erasing earlier losses after the rate announcement. The New Zealand dollar climbed as far as 65 cents US, a level last touched on May the 5th, and up 0.6% on the day. And the central bank projected the cash rate to rise to at least 3.25% this year from the current 2%. And the New Zealand 2-year bond yields rose 5 basis points to 3.19%. And they said, consistent with the economic outlook and risks ahead, monetary conditions need to act as a constraint on demand until there is a better match with New Zealand's productive capacity. A larger and earlier increase in the OCR reduces the risk of inflation becoming persistent, while also providing more policy flexibility ahead in the light of the uncertain global economic environment. The level of global economic activity is generating rising inflation pressures, exacerbated by ongoing supply disruptions driven by both COVID-19 persistence and the Russian invasion of Ukraine. The latter continues to cause very high prices for food and energy commodities. The pace of global economic growth is slowing. The broad-based tightening in global monetary and financial conditions is acting to slow spending growth, accentuated by the high costs of basic food and energy staples. European geopolitical uncertainty is also weighing heavily on business confidence and investment intentions worldwide. Likewise, COVID-19 restrictions in significant regions of China are exacerbating supply chain disruptions and adding cost and complexity to trade. They went on to say in New Zealand, underlying strength remains in the economy, supported by a strong labour market, sound household balance sheets, continued fiscal support, and a strong terms of trade. The reduction in COVID-19 health-related restrictions is also enabling increased economic activity, including hospitality and tourism. However, headwinds are strong. Heightened global economic uncertainty and higher inflation are dampening global and domestic consumer confidence. Asset prices, in particular house prices, have also declined, reflecting in part higher mortgage interest rates and increased supply of housing. On balance, a broad range of indicators highlight that productive capacity constraints and ongoing inflation pressures remain prevalent. Employment remains above its maximum sustainable level, with labour shortages now the major constraint on production. And the Reserve Bank's core inflation measure is above 3%. The committee agreed to continue to lift the OCR at pace to a level that will confidently bring consumer price inflation to within the target range. And the committee viewed the projected path of the OCR as consistent with achieving its primary inflation and employment objectives without causing unnecessary instability in output interest rates and the exchange rate. Once aggregate supply and demand are more in balance, the OCR can then return to a lower, more neutral level. And in the accompanying report, they said that mortgage rates are shooting up as higher wholesale rates are being passed on to mortgage rates. Mortgage rates at the most popular 1 and 2 year terms increased by around 20 and 5 basis points respectively between November and February statements. However, they've since increased by around 75 and 90 basis points respectively, and rates at longer terms have increased more, with 5-year mortgage rates currently 105 basis points higher than before the February statement. Higher mortgage rates have filtered through to large mortgage payments for many households over the coming year. Over half of the total debt is due to be repriced during 2022. As mortgages are repriced at higher rates, the average mortgage rate is likely to rise further. The average mortgage rate has risen to around 3% from 2021's low of 2.7%. The average mortgage rate tends to lag changes in the rates offered by banks for new mortgage lending because it mostly comprises fixed-rate mortgages that are fixed at the mortgage rate prevailing in the past. But they said that credit for housing is still growing, but the pace has slowed from its peak last year. This slowdown is partly due to regulations, including changes to lending rules under the Credit Contracts and Consumer Finance Act, the CCCFA, back in 2021. These changes have slowed down mortgage approvals due to tighter lending standards from banks. With the higher outlook for mortgage rates, banks have also increased the test interest rates used to assess mortgage serviceability, restricting the maximum mortgage size that homebuyers can borrow. The recently released March Credit Conditions Survey showed that banks reported a reduction in demand for household credit and that the availability of this credit has fallen. Banks expect demand for housing credit to continue to decline over the coming months. Personal consumer lending is falling, and the weak demand for this type of lending is expected to continue due to low consumer confidence, widespread COVID-19 in New Zealand, and rising interest rates. As a result, they expect home prices to fall. Despite recent declines, they say, house prices remain above levels that are justified based on their economic fundamentals. These fundamentals include, but not limited to, the supply of houses, yields from rents, the opportunity costs for other investments, the tax treatment of housing, and interest rates. From their peak in November 2021, they currently expect house prices to fall by around 14% by early 2024. While this seems like a relatively large decline compared to New Zealand's history, it would bring prices back only to April 2021 levels. That said, they say, the size and speed of the fall in house prices are highly uncertain. Rising interest rates have helped to cool the housing market. Mortgage rates have increased rapidly in the past 12 months, with fixed mortgage rates at the 1- and 2-year horizon increasing by more than 225 basis points. This has reduced demand from prospective buyers, especially in the context of high house prices. As a result, house sales have declined, causing the stock of homes on the market to rise as some homeowners continue to list their properties for sale. Gradually, they say, sellers will adjust their price expectations lower to find buyers or withdraw the listings. As existing mortgages have begun to be repriced, the average interest rate on all mortgage debt has risen by 31 basis points since its trough to 3.14%. Just over half of all existing fixed mortgages are due to reprice in the next year. Wholesale market pricing implies that the average or effective interest rate for all mortgage debt will increase to 5.3% in the next year. As a result, the bank says indicative mortgage payments for a new buyer could rise to close to 60% of median disposable income. This looks risky in the current environment, I have to say. But at the moment, there is no sign of the bank easing back on the gas. So interest rates are going to go higher, and we can see the consequences in terms of lower house prices, less mortgage borrowing, and more pressure to households. Now, how this plays out will be interesting to watch, and I will specifically be watching for the point at which the Reserve Bank changes direction again and starts cutting rates. I think it may be sooner than many expect. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.